The Federal Reserve is raising interest rates yet again to its highest mark in 22 years. The move comes after the Feds decided to leave interest rates alone last month. Bradley Blackburn tells us why.
Federal Reserve Chairman Jerome Powell says inflation is improving, but not enough.
The committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 5.25% to 5.5%.
The decision brings the benchmark rate to a 22-year high, and as rates have gone up, inflation has been falling and is now at 3%. According to the Consumer Price Index, or CPI, items like appliances, TVs, and other electronics are actually dropping in price. But necessities like rent, electricity, and food continue to move higher.
Fed officials would like to see all the components of the CPI and other inflation measures, that all components are moving lower.
The Fed's actions are easing inflation, but making it more expensive to borrow money. The average rate for a used car loan is 11%. Credit cards are close to record highs at 20.5%. And mortgage rates are near 7%, up from 5.5% a year ago. The question now, will those rates go higher? The Fed meets again in September.
I would say it is certainly possible that we would raise funds again at the September meeting if the data warranted. And I would also say it's possible that we would choose to hold steady at that meeting.
The Fed will consider economic conditions and, of course, inflation, which the Fed wants to see come down to 2%. Bradley Blackburn, CBS News, Montclair, New Jersey.